Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello, I'm Dong Jiaching, Tony. Let's begin today's group goodnight session. First, let's review yesterday's 2 questions and today's 2. Last night's economic data was strong, so let's see where that strength lies. Is it real or just on the surface? Second, because yesterday's data was so strong, it actually looks weaker in terms of growth compared to before. So what's the biggest focus for today? Today, the key is the PCE data. It can't be too high. If it's too high, then expectations for future rate cuts will be in trouble. If expectations for rate cuts are significantly suppressed or reduced, this will interfere with the valuation of stocks, and actually, it will have a major impact on the entire financial market. Now, let's take a look. Yesterday, let's first talk about the fact that the market was quite volatile. We should mention something that maybe everyone didn't notice clearly, because it was only bolded and not highlighted in color. Around 8:30 yesterday, the GDP data was released. The GDP was revised upward, exceeding expectations, while goods trade declined. As for durable goods orders in April, it was up 2.9%, which is very strong, but this is related to transportation equipment. When you include transportation equipment, it's the month-on-month increase was only 0.4, lower than previous but better than expected. Is this good? I think so. We'll look at details shortly. The number of initial jobless claims was actually the main factor driving the market reaction yesterday. The number of people filing for unemployment benefits was lower than expected. If you look at it, the expectation was about it was 230,000, dropping to under 220,000. We'll take a look at the details in a moment, and I'll especially explain my view on the job market to everyone. Then, as for the existing home sales numbers, they're about the same as the previous period, actually. Lower than the previous value, higher than expected, but the difference isn't big. The main thing we need to look at is that the GDP for the second quarter was revised upward, so the market is paying more attention to this upward revision, seeing it as a positive sign. Let me first mention that it was revised up to 3.8, and the main driver behind this revision was a boost in consumer spending. The initial estimate was 3.3, and I want to point out that this difference is quite significant. As for Taiwan's GDP, we calculate it year over year, meaning the third quarter compared to the third quarter, the second quarter compared to the second quarter, and so on. Most countries compare their GDP to the same period last year, but the US does it differently. Americans compare quarter over quarter and then annualize the result. In other words, their second quarter GDP is calculated by comparing it to the first quarter and then annualizing that number. This method is actually also used by some other countries around the world. Besides the US, another country that uses this method is Japan. But with this approach, there's a particular factor we need to pay attention to. Here, I've highlighted in green the quarters where there was a contraction. I want to point out that since this is a quarter-over-quarter comparison, there's an issue with the base period being high or low. If you always compare to the same period last year, the base period tends to be more stable, so the overall growth fluctuations should be smaller. But when you compare quarter over quarter and then adjust the numbers, the results can be different. It's possible that in the first quarter of this year there was a contraction because the economy was slowing down. In the second quarter, there was a significant increase. Because the base period in the first quarter was relatively low, so the rebound in the second quarter reasonable. Additionally, the BEA, the Bureau of Economic Analysis, also released the average annual growth rate of real GDP from 2019 to 2024, which is 2.4%. Why is this important? In the past, it was 3.3% or 3.8%. Let's not talk about those for now. What I want to point out here is that looking ahead, the expected growth rate of US GDP is around 2%, which is actually lower than the average. What you're more likely to see in the US is a slowdown in the growth rate, a situation where economic growth is decelerating, but it doesn't necessarily mean the economy is shrinking. So I want to point out this difference to everyone. So here, the first point I want to make is about the base period issue. If you look at the red box below, it becomes even clearer, because you're comparing the annualized numbers to the previous period. But the previous period was a contraction, so the growth this period seems very reasonable. Let's take a look. After hitting a low point, there's usually a period of relatively high economic growth, and that's also normal. Also, regarding the GDP numbers, I want to mention that the first release is usually the most important. For example, if the next release is in October they'll announce the preliminary GDP figure for the third quarter. Then in November, they'll release the revised figure, and in December, they'll publish the final figure. So, it goes, preliminary, revised, and final, with each being released monthly to complete the previous quarter's data. Usually, people still pay some attention to the revised figure, and sometimes to the final figure, unless, like this time, there's a significant upward revision, and when you compare it with other data, it gets more attention. Otherwise, people are generally pretty indifferent to GDP, especially the later revisions, because no matter how strong the numbers are, it's still about the second quarter, which is before June. What month is it now? It's September. So in September, what are we looking at? We're looking at October through December, and even into next year. So what I want to say is, whether it's good or bad, it's all yesterday's news. So when we talk about these numbers, I think they're worth referencing. They do show consumption, real growth, and the breakdown shows consumption growth is pretty good, which is positive. But first, there's suspicion that the base period was too low, and second, it's all in the past. Don't get too emotional about this. What's more important are durable goods orders. They increased by 2.9% month over month, better than the expected 0.3% decrease. The previous period saw a 2.7% decrease. Excluding transportation equipment, orders rose 0.4% month over month, while no change was expected. The core part also increased 0.6% month over month, again beating expectations of no change. Although these two sets of numbers are lower than previous periods' values, what I want to say is, as long as you beat expectations, is that really so bad? I think in the current economic environment, the economy is gradually slowing down in this environment, and yet, it's not particularly bad. Another important point, something everyone might have overlooked, is that, actually, the most important numbers in this set, if you're really doing analysis, are the last two figures. The first is core orders, which exclude aircraft and non-defense capital goods. This is the real core, the one most closely related to corporate capital expenditures. This shows a monthly increase of 0.6. Then, after receiving these orders, the shipments are directly reflected in GDP in the items related to investment. So, the core shipments actually decreased by 6.3% month-on-month. Now, it's true that there's a monthly decrease, but it matches expectations. So, overall, looking at these durable goods order numbers, as mentioned, they actually include categories related to artificial intelligence. In August, orders were a bit weak, but even in this weakness, there's some good news. The growth in orders is gradually spreading. It's expanding from the AI sector to machinery manufacturing. This is something we need to keep a very close eye on. Why? Because after Trump worked so hard to start a tariff war and push for manufacturing to return to the US, what's the prerequisite for actually bringing manufacturing back to America? It's not America's outdated infrastructure. Just starting up those old factory machines, working overtime and ramping up production, that alone doesn't really drive productivity. What truly matters is new capital investment. Only by putting in new investments will there be momentum for future growth. This is something very important that we need to emphasize. So, what we should be looking at more closely is, first, whether this expansion is spreading to other industries within manufacturing. There's also another chart I couldn't include here due to time constraints, but it shows that AI-related sectors have surged significantly. However, it also points out that even though everyone is making a big deal about AI right now, its share of US GDP is still not that significant. Yes, its growth is strong, but that's because it's a new industry, so its base is still relatively small. So, what we want to say here is that while AI-related sectors are indeed promising, their base is not large. According to the calculations, in the second quarter, AI probably contributed about 0.5% to GDP. So, while there is still a positive contribution, the overall impact of its growth on the economy isn't as impressive as its individual growth rate. In terms of growth, AI is still performing very well, but what I want to highlight is that the most important thing is the growth in orders, especially whether this growth in orders is spreading, particularly into machinery manufacturing. If you look at the screen, the black line represents new orders for core capital goods. What we want to point out here is that if you look at the black line, it bottomed out in 2023, and in 2024 and 2025, the year-over-year growth rate is gradually trending upward. So, we need to pay attention to this number. If it continues to rise, it's a positive sign for the future growth of the US economy. In particular, we need to consider that the current economic cycle may be heading downward, but it's possible that after a relatively mild correction, growth will resume. The most important indicator to watch is still non-farm employment. When non-farm employment starts to recover and grow, it could signal the end of the adjustment period for the US economy. That's the economic part. In addition, let's look at the number of people filing for unemployment benefits, which dropped to its lowest level since mid-July. Here, we want to explain that you can look at the US job market using two indicators. One is the addition and the other is the subtraction. The addition refers to non-farm employment, which represents how many people are being added to the job market. The subtraction refers to the number of people filing for unemployment benefits, which means those who have been laid off and are claiming unemployment. The US job market is weakening. What does this look like? It's more like stagnation, no firing, no hiring. There are neither layoffs nor new hires. This is the current state of the US job market. Of course, if you're unemployed or looking for a job, this situation can be really tough. For example, There have been reports that STEM students in the US have found it hard to get jobs since last year. This is a structural or frictional issue. But we should probably consider this more as a frictional issue. Looking at the current job market, companies are not willing to lay off employees. They don't want to lay people off. The number of people applying for unemployment benefits remains relatively low. We want to point something out. Let's look at the red text. We explained additions and subtractions, and the number of people continuing to claim benefits hasn't decreased. This is still a problem, indicating a lack of momentum in the job market. You can see here, the axes are different. The blue line uses the right axis, a scale of over 200,000 people, while the black line on the left uses a scale close to 200,000. The gap hasn't dropped significantly, meaning new job creation momentum is insufficient. Is this problem particularly severe? It's not especially bad. Recent data has been affected by collection issues, such as the Texas data outage and technical errors in North Carolina. Here, we want to tell everyone that even on the front lines in the US, when it comes to filling out documents, there are tons of loopholes. Don't underestimate Americans, even though they've been listening, reading, and writing in English since they were kids. There are still a lot of mistakes and misleading information when they fill out paperwork. So, you'll see this kind of thing happen a lot. There are people who try to cheat or commit fraud in the application process. The recent incident in Texas involving this kind of fraud isn't unique to Texas. It happens in every state from time to time. I want to clarify this first. As for technical errors, it could be that their reporting system has some issues, which might lead to over-reporting or under-reporting. So, what we want to talk about is something that happened recently. The statistical data has been fluctuating quite a bit, so they specifically mentioned that they didn't have a particularly strong reaction to this set of data. That's because they were already aware of the fraud issue in Texas a few weeks ago. As for the technical error in North Carolina, it should also be a short-term issue. These kinds of technical issues, like problems with the reporting system or related errors, aren't likely to be long-term. Even if the system is old or outdated, they'll eventually fix it and get it working properly. Here, we actually want to talk about something. The situation with the unexpectedly strong number of people applying for unemployment benefits is stronger than anticipated. So, what does this squeeze? It doesn't squeeze the expectation of rate cuts, but the expectation of significant rate cuts. Let me reiterate, the stronger than expected unemployment claims are not squeezing the expectation of rate cuts, but the expectation of large rate cuts. The expectation of rate cuts should still be within this trend. Unless we see upcoming PCE numbers really explode or something else happens, like some growth-related data can't hold up, then the expectation for rate cuts might expand. Or, if the inflation data surges, then the expectation for rate cuts will shrink. So, we want to point this out to everyone here. That brings us to our second topic. This year, the PCE absolutely cannot be too high. Data released Thursday was strong at the lower end. Let me show you. Last year, yesterday, 8:30 when data was released, you could see change in expectations for rate cuts. This is the rate cut expectation chart. So, when it goes past -1, it means it's certain there will be a 25 basis point cut in October. As a result, after data was released 8:30 yesterday, expectation for rate cuts jumped upward. Towards the end of the session it pulled back, returning to the initial level. How does everyone interpret this? When data was first released, everyone was pessimistic, thinking a rate cut was out of the question. But later, people started to think through, like I did. What I just mentioned is that it's not a reduction in expectations for a rate cut, but rather a reduction in expectations for a big rate cut. So, expectation for a rate cut has returned to a more moderate level, basically close to where the market opened, then moved up. We need to remind everyone, later today, when we see the PCE, we'll take a look. PCE absolutely cannot be too high. If it's too high, volatility will increase and correction will be larger. So, tonight's PCE, overall PCE is up 0.3% month over month, and core is 0.2%. It was mentioned that if the core is at 0.2, the corresponding annual growth rate would be about 2.9. So, let's take a look at the next analyst's distribution statistics. Right now, looking at 0.3, it feels like the analyst's consensus is quite high. You can see that the concentration is roughly between 0.25 and 0.35, with about 43 analysts falling within this range. So you might feel that this number is where the consensus is strongest, and theoretically, it shouldn't easily move outside of this range. Alright, goodbye. As for core PCE, it's probably going to be around 0.2, earlier it was 0.3. Also, we can see that although it's skewed a bit to the left, leaning more to the lower side, I still think the consensus is pretty strong. There is a slight risk it could move towards 0.25, but it depends on the actual results. The average is at 0.23 and the median is at 0.2, so there might be a bit of upward pressure, but not much. Looking at the year-over-year numbers, 2.7 has a strong consensus, and 2.9 also has a strong consensus. So, based on this analyst survey and their expectations, the probability of meeting expectations is relatively high. As long as it meets expectations, I think that's good enough. Now, what would be considered too high? If the month-over-month number, or let's say the year-over-year core number, exceeds 3, then that's definitely a problem. That would start to affect the whole discussion about the path of rate cuts. Whether there's still room for rate cuts would immediately come into question. If it goes above 0.3, it's possible it could drop to around 0.25, but you probably can't go any lower than that. Here, let me bring up again the momentum of core inflation coming down. What we're mainly referring to is that green line, the year-over-year at 2.9. You can see that it actually forms an arc. This arc also kind of gives the impression that it might be heading upward next. Of course, this doesn't mean it will definitely go up, but we need to stay alert here. This trend reflects that the momentum for a rise afterward could look relatively strong, so we need to keep watching. Even if it goes up, it might just rise moderately and then level off. There's still room for the numbers to change, so don't jump to conclusions too quickly. Also, today the preliminary value for the University of Michigan Consumer Sentiment Index will be released. It was previously said that it might be revised upward, but market surveys show it will likely stay the same. However, I want to tell everyone that there's a chance it could be revised up because of the rate cut. Usually, when there's a rate cut, consumer sentiment tends to be more positive. But I should mention that this is the median value, so unless the median is way off from the preliminary value, the market usually won't react strongly. Instead, the market pays more attention to the first release of the PCE data. So today, I just want to say that tonight's PCE absolutely can't be too high, because employment numbers are already strong, so if inflation rises again, rate cut expectations will be disrupted. Yesterday, Fed officials made many statements, and there was also some US news. We'll quickly review it. First, Milan advocated for a series of rate cuts, suggesting over 50 basis points, with each cut being 50 basis points, aiming to cut more and bring rates to a neutral level. Unfortunately, what he said was either right when the numbers were released or even a bit earlier. He started speaking at 8, and numbers came out at 8:30. So, his statements were contradicted by the subsequent numbers. Also, regarding the neutral level, his view of what constitutes a neutral level is clearly different from others, because on the dot plot, he's the one at the very bottom. So, he wants to cut rates by an additional 50 basis points. I think Trump will need to work harder to bring in more people. On another note, Grosby said that if inflation falls back to the target and employment remains stable, then rates can still be cut quite a bit. In other words, if inflation drops back to the 2% target and employment is stable. But I think what's more likely here is that inflation won't stabilize, but employment will fall. In that case, rates would still be cut. He said that there is still a moderate level of restriction, and that the new GDP data will not change his view of the trend. The timing of his speech was probably after this number had already been released, so he had a chance to add some explanations. Also, Smith from Kansas said, "No need to cut rates quickly, as inflation still needs addressing." This year, he's a voting member, and when he took office, his attitude didn't seem strong, but later it turned out. His stance is actually more conservative. Although his tone is mild, a gentle tone doesn't necessarily mean his position is soft. In fact, his attitude is rather hawkish. On the other hand, Bowman still maintains a dovish, accommodative view. He's become even more dovish than before. He believes that the market is fragile and that there's a need, if proven necessary, to cut rates further. But the problem is, he might not have seen the latest jobless claims numbers yet. Additionally, Federal Reserve Board member Barr made some comments, but they weren't related to monetary policy. They were about regulatory matters, so we can just note that and move on. As for Logan from the Dallas Fed, her comments also weren't about monetary policy. She just said that the benchmark rate should be switched to the overnight rate instead of using the federal funds rate as the standard. Then, the next day, another Fed official said that further rate cuts might be necessary, and that the timing of such actions would depend on inflation and employment data, in other words, a data-dependent approach. Actually, this was already the case yesterday. He was already leaning dovish. It's just that Chinese media reported it as depending on the data, while English media also said depending on the data, but the Chinese media left out that part. In addition, there were a couple of things, actually, 3 things, about Cook yesterday. First, he told the court that during the appeal period regarding his dismissal, he wants to continue fulfilling his duties. He also came out and warned that if he were to step down temporarily, it could cause chaos and disruption in the markets. That's actually true, because if he temporarily steps down, people would think that Trump is undermining the independence of the Federal Reserve, which would have a significant impact. Now, yesterday, there was a group of bipartisan American business leaders, Treasury secretaries, Federal Reserve chairs, and other economists who urged the Supreme Court not to listen to Trump's request to dismiss Cook. But let me tell you, this might have some effect on the judges, but I think the impact probably won't be that significant, since judges make their own independent judgments. That's basically the situation with Cook. In addition, there's another piece of news to add. The Federal Reserve's bank reserve system has dropped to $21 billion, falling below the US dollar mark, and this has been a decline for 7 consecutive weeks. This is crucial due to market liquidity. The Treasury's bill passed, raising the debt ceiling, leading to bond issuance. This strains bank reserves. Liquidity in debt instruments, overnight reverse repurchase agreements, and bank reserves are all affected. Previously, decreasing overnight reverse repurchase agreements meant money flowed into bank reserves. Now, bond issuance funding issues are also reducing bank reserves. This reduction in funds means less money flowing into the stock market. In Taiwan, we traditionally monitored M1, M2, and M3. M1B and M2, that scissors gap, all about liquidity. This is also about liquidity to keep an eye on. Especially if the stock market corrects and liquidity decreases, it creates a domino effect, worse. Corporate profits have surged, but worse than expected. Commodity trade declined, and I think this is related. At the same level, officials are initially scrambling to boost exports, but after that, things will gradually cool down. However, there's something to watch out for. This year, the US probably still has enough inventory to sell, but next year there will be a challenge. Will the inventory be sufficient? Companies will have to figure out how to manage their stock, because as prices go up, actual demand becomes a real issue. So here, everyone needs to pay attention to commodity trade in this area. Next year, the focus won't be on how much trade volume there is or how much it impacts GDP, but rather on whether inventory levels are adequate. Will there be pressure from not having enough stock, or from having too much inventory, which could lead to price-cutting pressure? The standoff between China and Ukraine remains unchanged, and the Kansas Manufacturing Index has rebounded due to interest rate cuts. Also, yesterday Trump made some comments. He said he would not allow Israel to annex the West Bank of the Jordan River. But the problem is, the buffer zones have already been pretty much divided up. When it came to Gaza, he said, "Enough, it needs to stop immediately." But I think everyone should just take these comments with a grain of salt. That's how it is. It looks like Israel's military operations probably won't stop. Also, Trump criticized Powell, but he mentioned something. He said our current interest rate will be in the red zone, and he also talked about balancing the budget. So, you see, he finally admitted why he absolutely has to push down the Fed's interest rates, because his debt burden is just too heavy. This is a potential concern. It probably won't be a real problem this year, but next year it could become a much bigger headache. Also, yesterday he said it was like being a gold medal beggar, and sure enough, this morning I saw exactly what I was talking about. He's already gone begging to TSMC, asking for investment or potential cooperation. But the problem is, come on, Intel and TSMC are your competitors. You're begging without even blushing or breaking a sweat. That really is gold medal level shamelessness. We don't really care about that. As long as TSMC doesn't actually have to lend a hand to Intel, it's a good thing for Taiwan no matter what. In addition, Trump has announced that he signed an executive order, and under this framework, it's already confirmed that TikTok has to be sold. But I want to point out that its potential valuation is $14 billion. Let's talk about this. $14 billion is actually much lower than what the market expected. At the very least, people were estimating amounts of $30 to $40 billion or more. So this is basically a very steep discount. But the question is, in my opinion, if something is cheap, there's a reason. Could the US be buying a stripped-down version? This is important. Let's go back. Trump said he reached an agreement with Xi Jinping, then made it public. China never made clear statements. They haven't said yes or no. They've only said things like, consider if the company is willing, ensure fair competition, and give Chinese companies fair treatment in the US. These are high-level statements without real commitment. So, we need to pay attention, as more details will probably be added later. Of course, once these details come out, the affected companies are Oracle and its investment team. Publicly listed ones are mainly Oracle and Dell. Dell holds a small stake, so its impact is minor, but for Oracle, it's significant. If OpenAI plays a role later, it would only affect these few companies. Note this is still just a declarative statement. I've bolded key points. We all know the most important thing: algorithms and code must be controlled by the new joint venture. I think we don't need to read this part out loud. What we mainly want to point out is that the price is just too low, so what you might end up buying is a stripped-down or simplified version. That's something you need to pay attention to. Another interesting piece of news: the U.S. Secretary of Defense, now referred to as the Secretary of War, Lloyd Austin, suddenly called together all the American generals, specifically more than 100 high-ranking generals, likely lieutenant generals and above, over 300 in total, and gathered them all at a naval base in Virginia near the Pentagon for a meeting. This is strange, because that day was the day before the government shut down. Could he be giving instructions on what everyone do if the government shuts down? Or because it's already September 30th, almost a month China's September 3rd military parade? Maybe it's related to that, or the Department of Defense has some policies they want to announce as part of this. We don't really know. We'll have to wait and see what happens. In addition, Trump was really aggressive this morning. He launched another round of tariffs. This round of tariffs is basically all under Section 232, because they're all targeted tariffs on specific pharmaceutical products. He's planning to increase them by 100%, unless these products are brought back to be manufactured in the US. In addition, he's imposing a 25% tariff on heavy-duty truck imports to the US. We'll see in a moment that some truck companies are actually performing very well. Also, cabinets and bathroom vanities will face a 50% tariff. Let me tell you who this is going to affect. It's going to impact Home Depot and Lowe's, and there's an even bigger victim here, IKEA. Because there's also a 30% tariff on imported upholstered furniture, which seems like a rather sudden move. This is going to impact their ability to find qualified suppliers, so that's something to watch out for. I think Home Depot and Lowe's might be able to adjust a bit faster, since they're American companies. They probably import semi-finished products and then do the design, cutting, or assembly locally. But for IKEA, it's a lot more complicated, because it seems like all of IKEA's US supply comes from Sweden. That means they're definitely going to get hit with these tariffs. Once tariffs are imposed, IKEA won't be able to offer good quality at low prices. There aren't details about this. Next, let's take a look at the market. The US dollar was driven up yesterday, with a big surge that surpassed both the 20-day and 50-day moving averages. Today, it's pulled back a bit. I think, in the short term, it looks like a bottom is starting to form. But whether it can rebound, and even if it does rebound, actually, that 200-day moving average is right there, so any rebound is going to be limited. Even though the US dollar is bearish in the long run, there will be opportunities for a rebound during a downtrend. I think this is a rebound in market value. And yesterday's the economic data was too strong, and on top of that, the yield at the auction for the new Treasury bonds was higher than the trading yield. So, the market reaction yesterday was quite significant, especially since both the GDP and employment report numbers were strong, which pushed the stock market up and bond yields higher. This is something to pay close attention to, especially since the 2-year yield went up by 1 basis point, and the 10-year went up by 2 basis points. We still need to watch whether the 50-day moving average can be broken through or not. If it does break through, it could be troublesome. Yesterday, the US stock market was actually affected by this as well, so we saw everything go down. We want to mention that today, though we not talk much, we see individual tech giant stock indices. Reminder to keep an eye on them. I think ever since Wednesday, everyone has been saying that a correction might be coming. Monday and Tuesday still looked optimistic, but by Wednesday, the situation of excessive deviation became apparent. Plus, after Micron released its earnings report, there was a temporary gap in support from earnings. So, looking at things here, it's possible things are about to turn weaker, so everyone should pay attention to this volatility. But if this weakness happens, if it were me, I'd hold on rather than rush to cut positions, because the outlook ahead still looks good overall. The S&Th wink with tongue sticking out is also trending down. Looking at the biggest gainers, Intel rose most, IBM also went up quite a bit, and Synopsys, which had previously dropped a lot, is now rebounding. Albemarle is in specialty chemicals. Yesterday I mentioned we should keep an eye on it, and now I remember, it's in specialty chemicals. This one went up. Carmex dropped poor earnings. JBL also fell disappointing earnings. Freeport affected by operations suspension at mine. Oracle, a pullback after strong rally. The Nasdaq continues its trend, especially the semiconductor sector. I want to highlight. The semiconductor index dropped 0.2%. It doesn't look like a big drop, and it's still closed with a bullish candlestick. However, looking at these last 3 candlesticks, lows and highs are getting lower. This isn't a good sign. It could turn downward. So pay more attention. Don't be too optimistic about this adjustment. This correction might last until September 30th because in the US, some foreign financial institutions closed their performance evaluation periods on September 30th because their fiscal year runs from January to December, with Christmas and then New Year's in January. So their bonuses are usually paid out around the end of December to January. Their performance calculation is different from Taiwan's. In Taiwan, since we celebrate Lunar New Year, the period usually runs until December 31st. But for them, as far as I know, a portion, actually a large portion, of foreign institutions closed their books on September 30th. So, if leading stocks start to pull back around this time, you'll notice that those big institutional investors might not be as motivated to buy in. Why? Because the new fiscal year starts on October 1st, so why would they aggressively build positions now? They'd rather let prices drop and then build positions at lower prices. So here, I want to point out something that people often overlook. Sometimes, these quarterly or annual factors can still have an impact. If the market keeps going up, there's no need to worry. But with things weakening, we must be careful. Could the recent decline worsen, correcting the index and its deviation from moving averages? Maybe after next week, things will pick up, or the market will just keep consolidating. We need to watch these things. Also, regarding the Magnificent Seven, you can see that yesterday they actually dropped by 0.1%. Again, you need to watch out for the risk of the trend turning downward. Here, you still need to be cautious, because yesterday also closed with 2 consecutive doji candles, which isn't exactly a strong signal. In addition, yesterday Apple went up quite a bit, rising 1.8%. Here, it's possible that among the turnaround stocks, tech stocks seem to be the strongest. If the sector is about to weaken and you need to find a safe spot, maybe Apple is still a place you can hide. Also, Nvidia closed with a bullish candlestick yesterday, but be careful. Even though it closed higher with a red candle, the downward trend hasn't changed. If today closes with a bullish candlestick, chances of it moving sideways are higher. But if that hasn't happened yet, stay alert. It's the same with Google. Its downturn is even more obvious. Previously, because the antitrust lawsuit's outcome created a favorable atmosphere for a while, but now things are pulling back, so be cautious as it could retreat further. Microsoft is basically moving sideways. Amazon, however, looks weaker. Each low is lower than the last. But I believe leading stocks have already started to correct, so everyone should pay attention to the GGO group. If this round drops further, watch where it might bottom out and where the decline might stop, especially with Amazon, because this series of declines has been really weak. So keep an eye on that. As for the index, it dropped 1.54% yesterday, so be extra careful. The 50-day moving average can't be broken. If it is, pressure will increase. Also, Tesla dropped sharply by 4.38% yesterday. Here, you can see that its short-term deviation is also too large, which is why I keep saying to be careful. The short-term deviation is just too big. Right now, there is indeed a chance for a correction. Let me repeat, I don't think the magnitude of the correction will necessarily be too severe. I think it's manageable. But the issue is, you need to be able to tolerate and handle the possible duration of this correction. That's something you need to pay attention to. Also, Oracle didn't do so well yesterday. It fell below the 300 mark. But even after dropping that much, it's still a bit above the moving average. So, keep in mind that its recent surge was due to a gap up, and it went up too quickly. I think the time it will need to consolidate in the future might be relatively long as well. As for its operations, I'm actually not as pessimistic as some others. I've seen some pretty negative opinions in the market, but I'm not that pessimistic. As for the triangular relationship between Oracle, OpenAI, and Nvidia, I think the main point, let me say it again, is that even though there's investment involved, Oracle is also buying Nvidia's chips. Nvidia, in turn, invests in OpenAI and brings the FBI in to buy chips. But the amounts involved aren't really equivalent. The most important thing is OpenAI's recent moves, whether they can actually seize an opportunity to prove they can be profitable. That's something really worth paying attention to. I think this might be the most crucial part of the entire AI solution. Also, Intel's so-called gold medal for begging is actually working, so their stock keeps going up. Even today it's still rising. If we go by this logic, Nvidia has been questioned, Apple has been questioned, and besides these, 2 of the top 7 have already been questioned. Will the others be questioned too? I don't know. After being questioned, I don't think everyone will end up investing, because it seems like Nvidia's $5 billion is kind of just a token gesture. It's probably not as bad as it sounds. They do have some strengths in CPUs. But here, we'll have to see if there are any more rumors about who they'll be questioned by next and how much money they'll get. That's also a way for the stock price to go up. That's just my take. On another note, Broadcom has dropped below its 20-day moving average, so you need to be careful. It needs to quickly get back above the 20-day moving average, otherwise, it could test the 50-day moving average. This is also a typical situation after a big run-up, and if it corrects down to the 50-day moving average, that would be a preliminary level of support. But it needs to rebound today for the correction to be considered complete, otherwise, it might continue. As for Micron, it also dropped yesterday, down 3.02%. But if you look, there's distance from the moving average, so this correction might continue. Still, I'm not bearish on Micron. With expansion in Shenzhen, and as server capabilities grow stronger, the demand for switches within Avico. Demand for network switches, especially Ethernet, is stronger, as is RAM. Everyone who went through the PC era has experienced this. This confirms one thing. Let's quickly look at how the market performed. Yesterday, oil prices were strong, seeing a decent increase. The main reason is heightened tensions between Russia and NATO. Russia appears aggressive, sending planes to provoke NATO. Even though they sent older MiG-31s, as a side note, since we'll discuss military industry later, I've always been interested in military tech. The MiG-31, despite being old, is impressive because it flies very fast and at high altitudes. When NATO planes spot a MiG-31 and try to intercept, they can't catch up. It's faster and flies higher. All they can do is try to lock on with missiles, but they don't dare to engage, which is frustrating. Trump has also issued warnings, so the situation is getting more tense, and that's why oil prices seem to be on a continued upward trend. Gold prices only dipped slightly yesterday, the decline narrowed, and prices moved sideways. Economic data was strong, yet gold also performed strongly. The main thing to watch is still PCE data. If PCE is mild, gold prices will likely keep rising. Many factors influence gold: potential rate cuts, Fed independence, U.S. fiscal policy stability, government shutdown risks, and Middle East wars. So, it's normal for bullish factors to push gold higher. As for Bitcoin, yesterday it plunged, but today there's been a rebound after the drop. However, what I want to say is that whether this rebound holds still needs to be confirmed. There's also something important. I saw on Bloomberg that the drop in cryptocurrencies reflects a shift in market risk appetite. That's also why I suddenly started to pay attention to this again. One reason the market is relatively cautious is that people think a correction might be coming, and you can see Bitcoin is moving downward. Bitcoin is basically an indicator of risk appetite. Only those who are very confident or younger investors tend to get involved in cryptocurrencies. So, when you see it starting to fall, it could mean risk appetite is retreating. You need to be a bit more careful. This is another thing you should watch out for in the short term. As for another piece of news that's putting pressure on Bitcoin, it seems that in Shanghai, China has launched an international operations center for the digital yuan. Since Bitcoin is a cryptocurrency, it's basically a digital currency issued by the central bank, so one is backed by the country's reserves. Whether this will squeeze out Bitcoin in the future is still unknown, but I'm just sharing this news with everyone. The most important thing is still what I mentioned earlier. If cryptocurrencies really start to fall, like if Ethereum or Tether start dropping, and if even Bitcoin keeps falling and forms a clear downward trend, then the overall risk area for the market will really increase. There's a pretty strong risk-averse sentiment in the market right now, so that's something to watch out for. Tonight, we have the PCE numbers coming out, and there are two scheduled speeches from officials, Barkin from Richmond and Vice Chair Bowman. Not sure if anyone else will suddenly come out and make unexpected comments. Now, let's take a look at how the stock market is reacting to all of this. Let's take a look. It seems like today's numbers are going up. In a bit, we'll look at today's PCE, which might be moderate. For now, let's first check out the economic data. 0.4 versus 0.3, in line with expectations. 0.0, in line with expectations. 0.0, meeting expectations good? It puts everyone at ease. Not too low, but everything as expected, no surprises in the market. At times like this, no surprise is good news. So, the stock market performing well, and the futures market shows clearly. The dollar has started to drop, and US Treasury bonds also weakening. This important. Why talk about this? Because expectations for rate cuts have huge impact on the entire market. Right now, market expectations for rate cuts too high. So, if things hold steady, it's better for the market. A correction necessary, but I don't want a bloodbath. A gradual, volatile decline be better than a sharp drop. But some consolidation needed. Let's look at how individual stocks are performing. PCAR is a truck company, so it's going up. This one, I don't really remember much about this company. HSIC, Intel are both rising. BA, that's Boeing, is also going up. They're all rebounding together. F9 is rebounding. eStore is rebounding. Today's gains show a very high proportion of stocks rising over 1% pre-market, which is good news. Now, looking at those falling, this furniture company is dropping, and the drop is pretty big. Wangsher should be an energy company, I think. That's a comparison. This freight company is down. KMAX, CarMax are both down. Their earnings report was terrible. Dale is down, and after Costco released its earnings, the situation wasn't good. Their earnings report was good, but performance wasn't. HPE, a US server manufacturer, and Dell, both didn't do well. Warner Brothers, in media, also performed poorly. Skywalk was dragged down. Apple fell too, but if you look at the magnitude of gains and losses, declines are noticeably smaller than gains. So, it seems like today, the expectation is that with the PC sector being relatively mild, there's a chance things could be a bit better. So, I think the market will still fluctuate and consolidate, but the pressure won't be as heavy. That's some good news. Now, let's take a look at everyone's questions. The stock market has gone up so much we barely recognize it. Honestly, there's a lot we don't recognize these days. Just look at housing prices, we haven't recognized for a long time. If you require funds investing in the US to be paid upfront in one lump sum, they might say that, but here's what would happen. First, South Korea would immediately back out. Then the Japanese would tell you, our new prime minister isn't in place yet. As for Europe, there are complications. The main thing is, the European Union is a supranational organization. It's an entity formed by various countries. If you want them to invest, does the EU have a treasury department? No. So where would the money come from? The EU isn't going to take responsibility for these things, so Trump can say whatever he wants, but after he says it, everyone just gets annoyed with him. You see, he just talks, but in reality, I think everyone will just mess with him. And the US is really short on money. The government's financial officials' performance, let me tell you, you can see how hard it is for the US to cut spending just by looking at how they quietly backed out of the debt ceiling standoff. This part, I think, is really telling. I think October 1st will be the first hurdle to get past. Then Hector was asking if we need UMC to step in and help Intel. Let me tell you, Intel might still. Intel might try tricks. Maybe Intel doesn't think UMC, but if anyone's to save Intel, UMC is the safest bet. Let's wait and see. None of this would be necessary. Best case, Jensen Huang saves them. Korea says this could trigger a financial crisis. Do you know why? What's the biggest difference between Korea and Taiwan? It's not about beating Korea. During the 1997 financial crisis, Korea's foreign exchange reserves were almost wiped out, basically zero. We have reserves, but Korea doesn't. Without reserves, how can they invest in the US or issue bonds? That just passes debt to future generations. If it's about raising taxes, then who would be able to handle that? So I think when Trump says things like, how can everyone be equally happy, just let him talk. After he's done, everyone argues, and it just gets uglier. And then, seeing him talk like that, it seems like he actually hopes the stock market will go down during this period. Otherwise, why did he push for those 232 tariffs yesterday, and then talk about this again today? Be careful. Trump, the investment advisor, might want the stock market to correct itself a bit, so we really need to pay attention. Alright, if there aren't any new questions, we'll end here for today. See you next week. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.